I mean,
And we're live.
yeah.
Y'all bear with me. I'm deal with another flare up of allergies, so.
Another flare. Dude, I never text you back. I'm sorry.
No, you're fine. There you are. I've got all kinds of
That's
material. Yeah, this is going to be very
Hey.
conversational today, so we need some interactive participation, Dustin. So,
I'm very, very good.
so hopefully there's some value here. I just thought
Dustin's good at answering, asking
he is
questions and
one
talking.
of the
yeah.
best. I mean, if not-
What I like to hear.
Is he?
So you be you today.
We're the best.
So I thought I'd talk a little bit about some things we've recently done and run into, and it might stimulate some conversation, some questions. And I mean, I have the answer, but I couldn't find the answer. But some things we're seeing that are kind of unique. You know, it's a weird market. I think everyone's probably experiencing that. It's been a weird real estate market. I know our company, like a lot of others, have done a lot to bring on new products and programs that can kind of fit some of those niche opportunities that you don't see every day, but they're out there. Like for investors, DSCR. We just closed one of those on a house out in, I think, Bluff City, where this lady who lives in San Diego is on Social Security and had been receiving rent off this house. And the only way we could get her to qualify was a DSCR loan, where we were leaning just on the rents generated from the house. And the house is vacant. She'd been doing renovations to it. So the appraiser appraised it, assigned a market rent to the house, and we could use that as the source of repayment to qualify her, because debt to income ratio, we never could get there based on other income she receives. So that was a win. We paid off a $50-some thousand mortgage, and they gave her like $100,000 in cash to pay off credit cards she'd used to fund this renovation with.
Dang.
And so all in, I think she was able to save probably $1,000 a month just on monthly payments. So really cool solution for investors who just may not be able to qualify. They have rental property, they want to acquire rental property, tax returns don't support the deal, but they have some cash. That either they need to have equity in the house, or they, usually 20 to 25% to put down. So loans we would like to do more of. One of the biggest limiting factors, I think, with the SCR loans is just will the market rent support the purchase price? Prices are up, and so is the market rent going to be enough to support that loan, given what they're paying for that house? So that can be a challenge. Some of these investors, they were going down below 1-to-1 coverage. So we have some that are 0.75 to 1, which it's hard to believe there's lenders that are willing to lend at a loss of monthly cash flow, and yet they are.
Do they look at income at that point?
The equity in is I think the thing. If they can rely on a 20 or 25% or more down payment, then that gives them the comfort and credit score. Think about a credit score. So
Do they look at cash reserves for DSCR?
oh gosh, that's a good question. A lot of the programs don't. Now, normally with Fannie and Freddie, you're going to have some reserves. It just depends.
DSCR is considered non-QM, right?
It is. It's a non-qualified mortgage. It's not going to be underwritten or sold to Fannie or Freddie behind the scenes. Yeah. So there's investors that are all about that world. We just did our first, and I may have talked about this last month or 2 months ago. We may have been starting it, but we just did a renovation loan. I had a client who a few years ago bought a house with an FHA loan. He wants to keep that house, keep that low rate FHA loan, and buy a new primary residence for him and his family. So he couldn't do, but he wanted to do a renovation loan. So he couldn't do a 203K because he already has an FHA loan. And so Freddie Mac has what's called a choice renovation program, where the buyer can put as little as 5% down of the total project cost. So I think he was buying a house for $315. He was putting about 85 or 90 into it, and we were able to get him in at 5% of the total cost. So at a very competitive rate, I think his rate was like 7.25%, so maybe a hair higher than market rate on a 30-year. But to get in at 5% down on a renovation loan on a house that was already in process being renovated was pretty cool. And we just closed that a few weeks ago.
So on those renovation loans,
Pardon?
on those renovation loans, the house is rough.
Yeah.
Are they all just speculating on the like ARV or like after?
100%. Yeah, it's a
David,
yeah. So,
we
so
think the camera can't hear it.
I'm sorry, Karen. Please. I'll be
Please
better.
speak louder, Karen.
So
Oh, yeah,
Matt's
we don't
question was about, does the appraiser appraise it based on the current state or the subject to completion? And it's gonna be on the projected value once the renovations are done. And so we have to get bid estimates and plans and contractor estimates. And all that's given to the appraiser, and the appraiser uses that to arrive at a as completed value. Now in this case, because the renovations were over 10% of the purchase price, we had to have a HUD consultant involved. Mr. Dennis Vaughn out of Morristown, Tennessee. He's the closest one to the Tri-Cities. So he came up a few times, and so in that kind of situation, we learned a lot because I'd never done a conventional renovation before. But the contractor and the HUD consultant have to be, very involved together, tweaking that budget, making sure everything matches, so that then they can send that to the appraiser. So if your client has the stomach for, and your contractor has the stomach for all the paperwork and licenses and all the stuff required to jump through those hoops, it can be a great program. It's just, are they going to be willing to do that? And in this case, they were. So.
What's the average time frame for that, or how long did that
I was
take?
just going to say, that's a great question. So average time frame to get a deal like that done, if you're going to do a contract on a house, I would say don't put it any less than 60 days.
Okay.
We would have been just fine just under 60 days, but we probably didn't plan well enough on the front end. We had to do an extension, and it ended up being fine.
Because of like contacts, or
Because of the logistics of getting the HUD consultant's revisions to the contractor revisions back to the appraiser, revising the report, just all that takes time, right? So, and you're dealing with people's schedules, when they can get out there, when they, so.
from Morristown?
From Morristown, yeah. So, but it all worked out, and they're in there right now doing the renovation, so it's pretty cool. Any questions on reno loans? They're possible. We're not out there hunting for them, but we'll take them on. I think one of my other big takeaways other than the time frame was, this is not going to be fun. You're probably going to not like me very much by the end of this. But if you can power through it, you're going to have something that no bank around here is going to want to do. A 5% down on a construction, they're going to want 20%.
Yeah.
So, and at a 30-year fixed rate. So a lot of the banks, they'll do 15, 20, maybe an ARM. So. Excuse me.
Have you ever worked on like when a house is in, like on a HUD website and you get under contract, have you ever had to deal with that process?
Yes, we did 2 or 3K on one of those. Earlier this
What
year.
does that process look like? Cause I haven't, he went to
Oh gosh.
he went to the property without me and was like, do I cut this lock off? I was like, what are you doing? No,
So-
go away.
Kyle's questions about HUD-owned properties that are for sale. If they
Once you're under contract, what does that process look like if you have the loan?
So, there's a ton of paperwork, right? Like all the HUD paperwork. And I found it interesting on the one we did, I don't think they even put a closing date in it. There's very little pressure from HUD on getting it done, which is nice because our borrower had a hard time getting a contractor to and it was a lower priced home out in Bluntville, I think. It was like $150,000 house.
Uh-huh.
She put like 10 into it maybe. And so her trying to get a contractor, a whole different conversation. But to your point, HUD, not that bad. I thought it was pretty laid back, other than the amount of paperwork that they have to, the realtor had to go through.
Okay. And it's their documents, right? Not our
Their documents, you're right. Yeah, not a traditional purchase and sale.
We're doing one right now. We did run into trouble on appraisal, where the appraiser said the electric and water has to be turned on,
Mm-hmm.
and HUD said they won't turn it on.
Right.
So what do you do in that case if it can't be?
In our case, it didn't have to be because it was a 2 or 3K renovation loan. So we were able to kind of get around that. Yeah.
Be careful with that. That can be,
Right.
because that's a game.
So was that an FHA loan?
It's just a conventional loan, but the appraiser
Conventional.
came back and said he wanted the electric and
The appraiser did?
yeah.
Conventional financing generally doesn't require utilities to be on or
did.
tested.
That's weird.
It is weird.
And we had to change.
Interesting. We're doing a lot of THDA right now. Are y'all seeing much of that? Down payment assistance.
I have a
the state.
USDA today.
Yeah. Those are probably better, I think.
Well, I don't know. Maybe it's just a client.
Yeah, it all comes down to that.
What comes to do?
But THDA, for those of y'all who haven't done a lot, essentially it's a down payment assistance program where you're doing a first mortgage, whether that's, we now do conventional, so we'll do a conventional THDA, FHA THDA, USDA THDA, and you're simply bolting on that THDA down payment assistance to that loan. So you can either get a 5% of the purchase price in that, as that down payment assistance, or a $6,000 lien. And one's repaid over 30 years, one's paid off when you sell or refinance. But it's a great way for a borrower who has limited funds to get to a house. Sometimes they still might need a seller credit if they need closing costs. So I think sometimes buyers think, oh, it's THDA, I can get in this house with nothing out of my pocket. It's like, well, not really. Now if it's with USDA, that's 100% financing with that down payment assistance, that can cover all their closing costs. But we don't see that too often. For one, we have 3 approvals we've got to get: our underwriting approval, THDA's approval, and then USDA's approval. So, not that those are hard to get; it's just more steps. And you gotta check all the boxes to get those done. So the client's got to make no more than what USDA allows or THDA allows.
Mm-hmm.
It's got to be in a geographic eligible area. So there's just more things that they have to kind of check through to be eligible.
How long do those normally take? Like 30 days is not feasible?
No, 30 is. I
Okay.
mean, maybe a few extra. A lot of it depends on the ease of underwriting the borrower. If they're responsive with giving the information to you.
Okay.
I mean, USDA turn time, we just had one that was about 2 to 3 days.
Hmm.
THDA was about 24 hours. So,
Okay.
Do
you
the
know,
buyers still have to do a class for THJ loans?
yes. I heard something recently where there may be a change to that though. There could be a change to that. Talking about doing a class for first-time homebuyers. The cost just went up. It went from like, it was funny, it went from like 85 to like $100 or something.
For the class?
For the class, yeah. Yeah, and it's an online thing they can knock out usually in an hour or so.
Is there any sort of conflict, like if they can't do a digital class and they need help, what would you suggest? We've had one who lives way out, no internet access, refused to do it. In that case, what would
How
you
about
suggest?
doing with the house?
The requirement is they have to do it, whether they come into the office, do a computer, whatever, they have to be the ones to do it. A family doesn't do it for them, right?
Yeah, I mean, I think that I don't know the mechanics of how that works. Like, how do they identify the person? Are they having to do bio sign or something, or
Right.
I don't know. It's got to go to their email. Now, if there's a family member sitting in for them,
Yeah.
where they give the login and stuff. I'm sure that happens.
You're like truck where you have to show your ID at the, on the camera.
Yeah, facial recognition or
That's
something.
true, yeah, sometimes.
Yeah, I don't know.
Good enough.
We haven't run into that yet. Yet.
You probably will.
Right.
You guys, work with like self-employed, 1099?
Oh yeah. Yeah, if they're 1099, and they'll have a Schedule C on their personal tax return usually, and we just need usually 2 years history. If they've been in business at least 5 years, oftentimes we don't only have to use their most recent year.
Okay.
If they've had declining income, or we don't want to use an average of the last 2 years, that's helpful. Yeah, self-employed borrowers all the time. VA loans, we just closed one for a borrower. A lot of people think that you can't have more than one VA loan at a time, and there's what's called bonus entitlement. And so we just closed a house for a client who he could get up to around $400,000 with a 100% VA loan while still owning his house in Alabama that had a VA loan on it.
Because it's in 2 different states, or where are they?
There's a website you go to, and you can punch in where they're moving to, how much. So when we do a VA loan, we're going to go do a certificate of eligibility through the VA.
Correct.
It says what their entitlement is. Plug that in, and there's a formula, and it tells us how much they're eligible for. Does geography have something to do with that? Maybe. We're doing another one right now where the guy still owns a house in California, had that loan for a long time. He's buying a house here, and he's no, that one won't conventional for some reason, but he could do a VA. He's wanting to do a 15-year. The pricing on a VA loan when you go to a 15-year is really not competitive. On a 30-year it is. So, but a lot of people don't realize that. There's the bonus entitlement is something that most people just don't think about.
So what states are you guys licensed in?
I'm personally licensed in 5 states. That's Carolinas, Tennessee, Virginia, and Florida. But we have a consumer direct division that's licensed all over the country. So,
I'm just asking, my brother-in-law's a VA, and so he's looking to relocate.
Okay.
Probably Alabama, so I'm just.
To Alabama.
To Alabama,
Mm-hmm.
yeah.
Yeah. I'm not personally licensed there, but we have someone.
Okay.
So.
It's basically like a surrogate loan for the company, where you can still be involved, right? And, yeah.
We have a couple guys, Joe and Paul, and they do loans all over the country. They're licensed in about every state. Paige's not here today. We just had a conventional loan over at Kingsport close. Nothing too fancy about that. I think first time home buyer, I think.
Paige was here earlier, and she had to go to Kingsport for a meeting and a showing at 11:30, so she said, I guess I won't be back in time.
Okay. So we don't see, I don't know if y'all see jumbo loans often, but jumbo, the new conforming loan limit is now just over $800,000, so you can go up to 8065 and not be considered jumbo. We don't like to go jumbo. It just means there's more constraints with underwriting, interest rates higher, more money down is required. And so on $1 million plus homes, oftentimes we'll do what's called we'll go up to the 8065, and then we'll add to that a piggyback home equity line of credit. And we have a company we can broker through, and that company will go up to 89.99% of the purchase price. So what that does is it allows the client to stay in a conforming Fannie Mae, Freddie Mac loan, no PMI because they're less than 80%, and then come alongside it with the home equity line that they fully advance at closing.
So is that, David, the jumbo loan or something to keep from having?
That's to keep from having to go jumbo.
Okay.
Most jumbo investors now won't go more than 80 to 85%. They used to go 90 or sometimes higher, but now I don't think you'll find many that will go more than 85%. But the rate's higher. A lot of these jumbo investors have weird exclusions that you may not realize till you get far down the process. And for example, I had one that fell apart. It was a really nice home in the mountains, but it was a log home, and this is actually no log home whatsoever. and it just killed the deal. I was like, well, who would have thought this is a $1 million plus house? And, the investor was just like, nope, we're out. So,
Wow.
but you know, we like it when we have to figure out piggybacks with big mortgages, but we don't see them that often. But we're doing a couple right now. So, but a lot of people don't realize you can do that, and still be able to put only 10% down, essentially. So,
Do you ever have people come to you with a down payment based on Bitcoin or crypto or anything? I've had a client in the past, so I'm asking about that.
so the question is, we have clients who come with like cryptocurrency as their down payment. We have had clients who have crypto that they want to use, and it's just a matter of, we have to document how it flows
Like the
from.
paperwork.
Yeah, so we have to see where it's coming out of, going into their accounts. They obviously have to liquidate it, to sell that, convert it to dollars.
Okay.
And as long as we can document the paper trail, we're fine with that.
Is there a timeline?
I don't think so.
Okay.
As quickly as they can get it in their account.
Okay.
Sometimes we'll run into clients who want to use their 401k or their IRA, and they say, yeah, well, I'm just going to pull money out of my 401k. What they don't realize is there's a process to that. They've got to request it. There's sometimes it's several weeks before that money can be in their account.
3 days. Is the norm.
I've seen it much longer than that, depending on the broker or the custodian. Depending
Maybe
on
with
the type.
401, but with Roth, no, you should be able to get it in 3 days.
Yeah. I think 401s or
Probably 2%.
yeah, if it's housed at a company plan still. If it's an IRA or Roth or something, it should be pretty. Yeah. So.
It's also, I've been looking at the self-directed aspect of it too.
Mm-hmm.
Rocket Dollar is a company, and they actually create a fund. They create an account, you can transfer money into it from a traditional or Roth.
Mm-hmm.
And then when you transfer that money, they obviously charge you fees.
Mm-hmm.
And then before you invest that money, it's got to be approved for a particular type of investment
Mm-hmm.
to make sure it fits into the criteria that it's used for.
Mm-hmm. Like real estate or.
Exactly,
Yeah.
and it's, they have a whole list, but before you can invest that money that way, they have to prove everything first, so it's all above board.
Mm-hmm.
I don't know what the fees are, I'll just start getting information from them.
Yeah, and then you got to keep it all contained with that too, right? Like you can't
Right, well,
go illegal.
Yeah, but when you create the account, it's just for that, so
Yeah.
they develop the account, you transfer from whatever retirement investment you have into that account, and then you ask them for permission to use it up, and then they approve that permission that you can fund that account from that other money, and that way you can utilize it. Now, again, I don't know what the fees are,
Mm-hmm.
but I know that's an option.
Mm-hmm. Gives you more flexibility and kind of
Absolutely.
things you can invest in. Yeah. Yeah, I hear some more and more stuff about self-directed.
It's getting to be real popular.
But some things to roll it out, they charge you a penalty, don't they? Is it always 10%?
It's 10%, and if you're under 59 and a half, you take that money as income, it counts for your taxes.
Mm-hmm.
10% is the penalty.
Yeah. We don't
But I think
usually
if
see.
you're over a certain age,
59 and a half.
If it's a qualified plan like an IRA or, you're really just subject to income taxes. We don't see that a lot, but from time to time, yeah. So, we talked about USDA. So one new thing with USDA, you may have heard this and seen it, but the debt to income ratio requirements have gone up. So your front end ratio on DTI, which means your housing payment can now be up to 34% versus was 29. So there's a little more room there. On the back end, on the total debt to income ratio, you can be up to around 45% on USDA. So some loosening there. There's sometimes where we'd like to go USDA, but the debt to income ratio is too high, so we end up having to go FHA, which is not ideal. So this gives a little more room to do more USDA.
I'm never gonna see 40-year loans.
They've come out before. We have, I think there's some DSCR products now where you can do a 10-year interest only, followed by the 30-year P&I. So if you look at an amortization schedule though on a 40-year, your payment's not that much less. You're paying interest for 10 extra years. I mean, it doesn't really help your cash flow. I don't know that it's really worth it.
Wouldn't really help affordability.
Yeah, sounds good. 40 years. Oh, my payment must be super
60
low.
years.
Yeah.
Just in debt
So-
for life.
At 50. Get a 60-year loan at 50.
There you go.
Feel like deuces.
And I'm smoking
Could be
2
a can.
cigars a day. Cut out water, only whiskey.
3 fingers.
That's
Liquor.
He's gonna die quick. So.
That's pretty much all I had. We're still in a weird rate environment. We're hoping that rates come down. I mean, there's so much uncertainty in the markets, and
How about on your profiles, like on your loans, are you seeing a lot more, that'll ask you too, are you seeing a lot more higher end like homes, like 300 plus, are those still moving pretty quick? And are you seeing like a delay in like the 185 to 285, 300 range?
I think it's just it's kind of all over the place. Honestly, I should look at our whole team. I mean, I tend to just look at what I'm doing more so than what our loan officers are doing. But Matt's questions about like average purchase price, loan amount. I mean, like right now, I'm gonna have a loan closing next Monday. It's a $628,000 loan. They're putting 10% down. There's a house out on the lake, I think, or near the lake.
How was that my closing? With Kathy?
It's a different one.
Oh.
But that one too. That one's a little less, right?
Well, they have a loan, you have the seller's loan and the buyer.
Right.
Yeah.
That's a different one. It's a little less. And in both cases, well, in the one case, this couple that's buying the more expensive house on the lake, they came here 2 or 3 years ago and bought a house, rented it out while they were transitioning from California, and then got to know the area. Then they lived in that house, and then now they're buying their dream. Now that they know the area, they're buying their dream house. Could probably put more down if they wanted to. Don't want to liquidate stocks and all that. The couple that's selling their house, they're buying. They're taking a whole bunch of equity out of that house, rolling it to the new. And that's you wouldn't know that, I guess, but that's a $600,000.
$595.
5 something. Okay. Yeah. And then you have plenty of in the twos, and the one Paige just sold is what, 126,000. I mean, little house on Sevier Street.
In Kingsport.
Yeah. I mean, it's just and my client that's doing the piggyback.
It was nice seeing
Good
you
to
guys.
see you,
I gotta
Kate.
go back to
All
work.
right, take care.
Thanks for coming.
Yeah.
See you guys.
Bye.
And then the piggyback HELOC one that we're doing, that's a $1.37 million house out in Piney Flats, new construction. I mean, just
I'm seeing if it's like on the lower end, if it's priced well, it's moving quick.
Yeah.
But if we're still trying to like reach for the stars,
right.
and everything's just kind of sitting. I don't know if that. And I talked to a guy. He's out of Maryland. They have a similar kind of socioeconomic breakup a little bit, and just that price point is sitting. And I don't know if it's that economic background is more like we're afraid of the economy, we're afraid of tariffs, we're afraid of what's going to happen, and so we're on our heels. We're still going to rent. And the ones over that, it's kind of like, all right, cool. I still got to buy a house, so 600,000, no big deal. 7.5.
I think some of the ones too. It depends on I think people, and y'all know this better than I do. But you see houses that go for sale. It's a pretty good size purchase, and then you look at it, it's like, well, this was probably a really nice house 25, 30 years ago.
Yeah.
Now that person is not only they're looking at buying, spending $700,000 or $800,000, but they're also maybe having to look at a lot of renovations.
Yeah, they used to jump on it. Now they're like,
Yeah, and are they willing to take that on? Are they able to take that on? And I think some of your inventory might be sitting because of that. You think
makes sense.
it's just dated. So you take the purchase price plus the higher rates. You
Plus the
you add on to
renovation.
that, and it's just like, ugh.
People are saying,
Yeah.
that makes sense.
Yeah.
I think that's where it could be too.
Are y'all seeing a lot of D.R. Horton stuff move? Is that?
I have one right now.
Yeah.
And there's actually a whole USDA community.
Oh, really?
Mary
That's
Ellen
awesome.
told me that yesterday. I don't know where it is though. I don't know if it's in Bluntville
That's
or.
smart. I mean,
We
it's,
got a whole pool of
Starts at
buyers that are
327.
interested. And that makes sense, cause I mean, too, well, like, I don't know,
We've had quite a few closings.
Eastern 8 will build
this year.
a new construction that's USDA approved,
Mm-hmm.
so.
I only found 4 3-2s in Hawkins, Sullivan, Carter, and Washington that were USDA.
No, that's rough.
Yeah, and I found, one of them's in Churchill, and I got it, I hopefully have it under contract today.
Yeah.
But it's difficult to find.
Huh.
It's really difficult.
That's
I mean, if it's a
surprising.
300, it might be different, but like, I think I went up to 270 on my search.
Mhm.
3-2, above average, average, in all the counties.
Well, limited to that price, that makes sense, I guess.
Yeah.
Yeah. That sounds like a 5 year ago price. I mean, it's sad. It's just, I feel so bad for a lot of these buyers. It's the affordability is really an issue.
I've been able to get almost all of them covered with closing costs though,
Mhm.
and just going up a little bit on the purchase price.
On the middle
And it's
ground.
still appraising.
If it's up high, I feel like I've been in multiple offer on a few of them. If it's a nice Tennessee Dream type home, like it's competitive on site. It's like a 50-50 market of buyer versus seller market. But if it's on that side, it's like I can get you money off and closing costs. But if you're, it's the house. Well, now there's 7 offers on it. 2 of them were cash, so.
Right.
Yeah, it's weird.
Right. Weird market. Yeah. What else is on y'all's mind? Anything else?
It's probably out of your jurisdiction. I think it's interesting of the capital gains. Everybody normally wipes it away when it's a primary residence. They go, oh yeah, it's primary residence. Well, isn't it if you're a single person and your profit is over 250, you are now I don't know if it's 250 is no longer under capital gains, anything above that.
I think anything above
capital
that.
gains.
I think anything above that.
Okay. And then if you're married, it's 500,000.
500,
Yeah.
Will you summarize that, Dave?
Sure. Some asked questions about capital gains, and I'm not an accountant, so but if you sell, you've been in the house at least 2 years. You look at your gain, which is what you made over what you bought it for, essentially. If you're a single person, it's over $250,000 on your gain, then you're going to be subject to this capital gains tax on the amount over the 250.
Okay.
Isn't there legislation to move that up, capital gains?
Probably.
I don't know. Maybe with Trump stuff.
I don't know. Yeah. And then if you're a married couple,
That'd be cool. I know 100% bonus depreciation's been approved, and it's retroactive to this year, so that's cool.
Yeah. Good stuff.
But that's good to know, because a lot of times your sellers, especially, are going to ask you like, "Hey, am I going to get capital gains from this?" Especially if they're older, because like that's the hidden thief is taxes. So I just got in the habit of like, "Oh no, I mean it's your primary residence, man. You lived here for 20 years," but then it's like you bought it for $350, and now we're selling it for $900,000.
Right.
It's like,
Well, it's a good problem to have. I mean, if they're making that much money, I mean, come on, share some with the government.
yeah, come
I'm
on,
kidding.
get some not to say.
No one wants to give more than they have to. But
David pays
but you
more
know,
taxes
the
than
capital
he used to.
gains, depending on their income, may only be 15%.
Yeah, because it's attached to what their tax bracket is.
Right,
So
right. So
it's not just we're all taxed.
and then if it's over a certain income limit, I think it's 20%. So I mean, it's not like we're talking 40 or 50%. Thank goodness.
That's good to know.
So, yeah. Good old capital gains.
Oh yeah.
The tax man.
Are there any new regulations for Project Foundation for a mobile home?
USDA now goes back 20 years on a double wide,
That's good.
which it was that's
I've been telling people.
that gets us an extra year. It was if it was manufactured after January the 1st.
Yeah.
I'm talking about manufactured homes for USDA. If it was manufactured after or before January 1st of 2006, it would not have been eligible for USDA.
Okay.
If it's if now they changed it. It has to be 20 years older and newer.
Okay.
So that gives them an extra year.
Yeah.
So
Better than nothing.
sure. Yeah. did a THDA double wide. Our USDA was not, our USDA that we just closed was a house. But,
Y'all don't do single wides, you just get, right?
we can broker single wides. The thing with single wides is, they're not typically, they're not typically set up on permanent foundations, I think, as a whole, right? So with double wides in Tennessee, and I think all over the country, if a double wide is set up in Tennessee, it's gotta be set up according to HUD standards, and therefore it's on a permanent foundation. Single wides generally are not, so they're kind of moving around. They're more likely to be moved. And I don't have a ton of experience with them, but I just know that they can be done. Most lenders won't do them. We have a broker partner who does them. So they can be done, but they're probably it's gonna be subject to a structural engineer probably to verify it's done correctly. I can't speak to the rate, or it's probably not gonna be as great a rate either,
But it can be done.
can be done.
Permanent foundation, depends on the foundation inspector you call.
Yeah, it depends on exactly, but they call it permanent foundation.
Yeah, I have seen that be a very flexible definition.
Yeah, exactly.
Yeah, a lot of people think it has to be like some kind of block or something. It doesn't. It can be the skirting. It's just how it's underpinned and all that.
So just take the front bill off.
One thing,
A couple will fail it if it has skirting.
well, the thing about skirting is it has to keep
Varmints
varmints out, water. So that could be debatable, I guess.
Yeah.
Does it really keep all the water out?
Yeah, I know. Let's just like it says block. Does it keep all the water out?
Right.
Depends where you are,
Well, thank y'all for having me. As always, if you think of anything else you want to run by me, just give me a shout anytime. And really appreciate y'all having me.
I want to say Dustin was very quiet today, unusually quiet today.
Abnormally quiet. You okay?
Thank you, David.
All right.
Blotting.
Blotting.